Welcome to the Organized Investor PodCLASS with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. Think of these pod classes as a college of knowledge, and the curriculum is an inside look at how we work with our clients to organize their investments, their retirement, and their affairs. Our process is certainly not the only approach, but it has served our clients well. Listening may materially improve your life as well, but for that to happen, it also takes an open mind, an interest to learn, and your trust in what we're sharing. We focus only on what is relevant and will explain things several times in different ways over multiple classes to ensure you understand their importance. We suggest you subscribe so you'll receive reminders about the next class. And with the tools and information on our website, theorganizedinvestor.com, you can start getting organized right now.
Welcome back, students, to what is our 17th pod class and the 11th in a series on the subject of organizing your investments. So what is your favorite all-time legal show? Maybe your movie or your series on Netflix. There's a long list to choose from. Some might be LA Law, Boston Legal, trying to think what else. My Cousin Vinny. There's Perry Mason.
That one's my favorite. I could watch that. My Cousin Vinny, I could watch it 10 times. But anyway, I continue.
I don't really remember it. I know it was popular when I was younger and I've seen it, but I don't really remember it. I might need to go back and watch it again. I just remember it being a law movie.
Yeah.
There's also Law and Order, of course. Everybody, I feel like, watches that. Mm-hmm. There's the old school Matlock series, which is always good. There's Suits. I really liked Suits. I watched that during COVID, so that entertained me for a while.
Yeah.
And then there's Night Court. There's actually Night Court, like an updated Night Court.
Yeah, I think that I like the old one better.
Yeah, I agree. The other one's kind of strange. But anyways, there are many to choose from. So regardless of your favorite, all of these shows have one thing in common, which is the discovery process before a legal proceeding where the evidence and the facts of these cases are actually compiled.
So we decided, what better way than like a discovery process to make our case that it may be possible to materially improve someone's long-term financial future. That's our plan here. And to explain exactly how we're going to do that with our current clients.
After taking a recess from the last episode, we'll resume with our deposition of Jerry Goodman on the overall topic of organizing your investments. As PodCLASS listeners, we ask that you listen closely and decide if the comments and the evidence in these proceedings are truthful, compelling, and believable. I'm Megan Hubbard, along with my dad, Jerry Goodman, and whoever is there with you, we're glad you're able to join us. I'm a former first grade teacher at Christian Academy of Knoxville, and Dad won the state oratorical contest for the Optimist Club back in 1971.
Dun, 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 dun. Sorry.
He still wears his medal around sometimes.
I know. I'm so proud.
I have a master's degree in curriculum and instruction. So for our discovery process, I have the role of the question asker. And on episode 16, we decided there were how many ers?
Seven ers.
Okay. So Dad is a certified financial planner. So for this discovery process, he'll be what is referred to as the deponent, also known as the question answer.
Did you get
seven?
Okay.
I think so.
Well, that's good. That was close. So let's start off with the usual hear ye. And since court is not really in session, we'll be deposing me. I'm the deponent, as opposed to the degenerate, I guess someone might say. And the matter before this pod class is including the topic of organizing your investments. And is it possible to materially improve one's long-term financial future? That's our plan here.
So, Mr. Dad, you're still under oath from when we started this deposition that started in pod class number 16, okay?
Yes, ma'am, I am. And I'm still going to tell the whole truth and still nothing but the truth, including jokes. Okay. My jokes will be truthful if I tell it.
We should probably put those in as evidence, but anyways. So this deposition is because you've been accused of repeating yourself in these pod classes, and you did plead guilty yesterday.
Yes, I did. That is correct. I continue to plead guilty. I continue to repeat myself because As I've mentioned in the previous podcast, I've said this many times before and going forward, it took me 6 months, 6 long, glorious months to come to understand the importance of what we're going to share, what we are sharing, what we're going to share. And it may take a while for all this to sink in for our listeners as well.
Now, for someone who is just joining this deposition, you explained that dividend growth is a strategy of investing in well-managed companies with a history of raising their dividends each year.
That is correct. And we submitted exhibits in our evidence, A, B, and C, to document just how successful this dividend growth strategy has been. It's pretty impressive stuff.
Okay, so can you give us a brief reminder of the exhibits, please?
Yes, ma'am. Exhibit A. This is a summary of a research list from Wells Fargo. It's called the Diversified Stock Income Plan. And with a big fat name like that, you understand why we refer to it as DSIP, instead of Diversified Stock Income Plan. And its return has been 12% a year over a 30-year period. That's Exhibit A. Exhibit B is a maybe we'll call him Ned Dervis, but it's really Ned Davis. Ned Davis research summary that also shows the outperformance of this dividend growth strategy, but it's even over a longer period of time than 30 years.
So let the record show that exhibits A and B are both on the investments page of the website, theorganizedinvestor.com, if you'd like to go and review those yourself.
They're riveting. And also Exhibit C, those are really what we're entering into evidence in terms of pod classes number 11 and 12. And in those pod classes, we explained in detail the 84 advisory accounts that we've managed for at least a 5-year period that focuses also on this dividend growth strategy, what we've been doing. So as of the end of January 2024, those 84 advisory accounts, they had an average net return after any kind of fees and expenses, anything related to that, net to the client, it was 14.06% per year for those 5 years.
Well, that was pretty brief.
Well, yeah, I also would like to say that if you extrapolate out that 14.06% per year, over a 5-year period, for example, it's equivalent to an increase in value of 92%. So that makes it quite not so brief, but just keep that in mind. It's almost a double in value.
Okay, so it didn't double in value, but it was close.
That is correct. And our suggestion is for listeners, what do you do with this? I mean, compare that 5%, that 5-year 14% annual return to the performance of their own portfolio. Let's kind of see if maybe they have some room for improvement.
So you've been harping on all of this for a while, and that term dates back to the 1500s, which means playing on the same note over and over again. We talked about that yesterday.
Mm-hmm. Right. And I'm harping on this for 2 reasons. Reason number 1, dividend growth. This strategy is the most consistently profitable investment strategy I have ever found. And I've been in this industry almost 43, 44 years. Been a long time. Reason number 2, since it took me about 6 months to finally realize the potential of this dividend growth strategy, keep in mind, if we don't keep harping on this, a year from now, the listeners they will still be invested in some portfolio that probably has mediocre performance, the same thing that they have right now. That's why we harp on it.
So remind us exactly who you are trying to harp on.
First group is really simply said, this is not one of our clients already because they don't understand kind of the benefit of this as our clients do who are already invested in this strategy. Now, the other group may seem a little odd, but these are the families of our current clients because why would that be? It's because they need to know what we're doing with the assets that they're probably going to eventually inherit. And because of all of this, because this also may help them, let's put it this way, with their own investments. And I'm talking about helping them right now, not 20 years from now, when they may become a beneficiary.
So this whole dividend growth strategy, it doesn't sound as fun as buying Bitcoin.
Oh, no. There's a whole lot of things more fun than this. But investing in stocks with a history of growing their dividend, okay, it's not the most exciting investment idea on the planet, but we're not doing this for entertainment value. Wish we were, but no, that's not. So
are you saying to this podcast that this dividend growth strategy, as you refer to it, is boring?
Well, I'll tell you what, it's safe to say that Smucker's jelly is not as entertaining as buying NVIDIA stock or some other high-tech flying company, okay? These dividend growth companies, they're very attractive to investors. And that's because they're very well-managed companies, and they've shown that they have the ability to not only pay a dividend each and every year, but they have the ability and will do this to continually and consistently increase that dividend year after year after year.
So other than Smucker's, what are some other boring companies in this dividend growth strategy?
Okay, so let's take a look at the DSIP list. We mentioned this Exhibit A. It's on the website. There's usually 70 to 80 companies on this list, and most people will recognize probably at least half the names on the list, probably more. You've got whole companies that maybe a small company you've heard of called Apple. Yeah, that's on the list. Most people have heard of Home Depot, Lowe's, Becton Dickinson, Costco, Walmart. That's kind of the most common, obvious names that people would recognize in terms of what these companies are or who they are.
You said these types of stocks are less volatile. So does that mean it doesn't get mad very easily?
Yeah. Well, let's use a technical term because people like the fancy words. It means the market price of those stocks, it isn't very bouncy aroundy. Okay. That's a very technical term.
You're right. Not very bouncy aroundy is very technical.
It is. It's meant to impress the listener. So to use some more language, like let's call it plain English, it means they don't move up and down in value as much as other things, just by comparison.
So what makes these companies less bouncy aroundy than the other stocks? I feel like I have to say it that way.
Well, it sounds better. I think we've said this before. It's because these companies, as the list I just mentioned, like Apple and Walmart and Home Depot, these are consistently profitable companies. Okay, they not only pay a dividend, but they've also consistently raised that dividend for many, many years in some cases.
Come on, Mr. Dad. Do you really expect the podcast listeners to believe that shareholders would like that?
Who wouldn't like that? If you think about this and its end result, okay, that's why they have such loyal shareholders, and they're very unlikely. They're not as likely to sell their stock, even when you get into a market downturn.
It sounds like the listeners are not going to get rich overnight, are they?
No. It might take a week or so. But no, seriously, how does getting rich sound like doing this over a period of time? Because really, that's what this is about, okay? Is that okay?
And how would you respond to someone who thinks the returns from this dividend growth strategy are just not good enough?
Well, I got to jokingly say, well, you just can't please somebody, can you? But I do know one thing, okay? The the single biggest objection to this dividend growth strategy is FOMO, FOMO, which maybe you've heard the term before. It refers to the fear of missing out, FOMO. So we'd like to introduce in Exhibit D into evidence, which is a summary on the investments page of our website. Once again, it's theorganizedinvestor.com. And guess what, Megan? We named it Fear of Missing Out. What a catchy name that is.
So creative. So with a name like that, I guess someone's afraid they're about to miss something.
Good guess. And since this is Exhibit D, and since you're a lot more fun to listen to than me, how about you read the first paragraph of this FOMO summary report on the website, okay? This will be better than just trying to paraphrase it. So go ahead and just unload that on us, Megan.
Okay, I think that was a compliment that you would rather listen to me, but then I think I also am having to tell the boring parts, but okay, whatever.
Well, that's right. You'll make them fun, I'm sure.
Here goes. Fear of missing out. FOMO. We could make it like a song.
Yes.
As we explain our entire process to hopefully improve your overall performance by 2% and how this works in real life, the most common objection we hear sounds something like this. We agree with you that this dividend growth strategy does provide growing dividends every year. These are really good companies that have appreciated a lot, and mechanically reinvesting the dividends is a great idea. And even having the dividends helps to mechanically withdraw money during retirement. So you're right about all of that. But what if there's some stock out there that goes from $30 up to $400 and I miss out on that?
And folks, PodCLASS listeners, that is the most common objection we hear about dividend growth strategy. That is it. They're concerned that some $30 stock, it might go to $400 and they don't own it.
So they're worried about missing out on the next big winner in the stock market. That's what you're telling us.
Yeah, pretty much. And on that same summary that you just read from, we have there a 20-year graph of the NASDAQ Composite Index from March of 2000 through March of 2020. Okay, it's a 20-year graph. So, Megan, for the PodCLASS listeners, how about you read our response, like you read kind of what their objection was. Read our response on that same summary sheet about this what if I miss out kind of concern.
Okay, so our response would be, yeah, you're right. what if? And there's also the Powerball lottery as an idea if you want to go buy yourself a ticket. So below is a graph of the NASDAQ index for a 20-year period when it realized an increase of only 11.7%, which is an average of 0.6% per year. We decided to cherry pick these particular dates to make a point, but what if you had retired in March of 2000 with your retirement nest egg invested in this part of the stock market and have very little to show for it over the next 20 years? There's a what if for you.
You're listening to an Organized Investor PodCLASS, which makes up our College of Knowledge. Your hosts are Megan Hubbard and her favorite father, Jerry Goodman. You'll benefit most by listening to at least 12 PodCLASSes. And the best way to be reminded is to subscribe on your favorite podcast platform.
Yeah, that's a big what if. So thanks for reading that. And again, the summary that Megan just read is on the investments page of the website. It's called Fear of Missing Out. So the question is, the comment really could be, you only get one chance to save for retirement, and you only get one chance to actually be retired. So how much risk are you really willing to take? And here's another question to ponder. How much risk would your spouse be willing to take if they were included in some of these decision-making processes that sometimes you might be making?
So are you saying to avoid technology stocks?
Absolutely not. But what we're doing is reminding our listeners that bubbles happen. Bubbles can burst, and it can be pretty ugly when that occurs, okay? It can be pretty nasty, particularly when you're dealing with retirement savings.
Like the tech bubble that happened in the year 2000?
Exactly. And that's why we just use this example that started in March of 2000. And we admit to cherry picking the date, okay? So if you look at that graph, it took 17 years to gain back what it lost. 17 years. And if you exclude the dividend and adjust it for inflation, the annual rate of return for the NASDAQ Composite Index, the average was 0.6% a year for that entire 20-year period, okay? So now what we have is artificial intelligence, which is the new buzzword on Wall Street that's going to entice investor interest.
Can you make a case to invest in artificial intelligence?
Sure, but I'm not going to, because everybody else is doing that for us, okay? Let's talk about 2023. We started hearing about what was called the Magnificent Seven, which later became the Magnificent Five, and then it was Magnificent Four, as some of these stock prices started to falter after some really big gains, but they do start to slow down at some point. So we're making the case that it's possible to materially improve your long-term financial future, and this dividend growth strategy is a much more dependable way than any other approach we've found.
So what do you think of NVIDIA?
NVIDIA is a very well-known stock in the artificial intelligence space, okay? And according to the stockanalysis.com, its revenue has grown almost 40% a year. If you go from, say, 2019, and the stock price has gone up very, very much as well. So it's been a great company. But compare that to Cisco Systems, which was in the forefront of the router industry, and it almost had the same identical dividend growth of about 40% over a 5-year period. And that was between 1996 and 2000. Okay, very, very similar.
This sounds like it's not going to have a happy ending.
Well, it's not a terrible ending, but between 1997 and 1992, just as a reminder, Cisco Systems went from $10 a share to around 80, okay, which was a huge move. Then the tech bubble burst, and then it went all the way back down to almost 10, kind of where it started. And here we are 22 years later, and the stock is trading in the $50 range.
So it did make some money for investors.
Well, yeah, but not for somebody that bought it when it was above $60 a share. And so, that's 20 plus years later, it still may be down from where they bought it. So how many people can afford to own a company for, say, 20 years, maybe during retirement, and they actually end up losing money on it? I mean, it doesn't sound that good, does it?
So what's the point of all of that?
Well, there's a couple of things. First, at some point, a good company won't be a good investment, okay? Next, bubbles are not limited to just the stock market, because you have things like you have gold, mortgages, housing. Let's talk, the Japanese economy is a great example. Internet companies. Those are just a number of these things, okay? All of these types of investments, they all offered an opportunity for some significant wealth creation. It's easy for me to say. However, they all experienced at some point in time a bubble that eventually burst.
So you're saying technology stocks and AI companies in particular will have problems down the road? Is that what we're hearing?
So whether you're talking about 3 weeks from now or 3 years down the road, I would just caution somebody from assuming that an artificial intelligence bubble can't burst. There's lots of examples of great companies and great ideas that eventually run their course, and nothing is great forever.
I get that, but can this dividend growth strategy have a bubble that might burst?
Well, you never say never, but this is a strategy that's not tied to one single idea of the moment, that causes everybody to pile on at the same time, and make it overvalued. It's really kind of this timeless approach because it focuses on well-managed companies who raise their dividends. And that really covers a wide swath in the whole market.
So all of this advice and your strategy is to materially improve the long-term financial lives of, the clients that you have, but you haven't said anything about the economy.
Let me say that just because something is interesting doesn't necessarily make it important, at least in terms of how it relates to your financial success, okay?
Well, what is the English translation of what you just said? Because I'm not sure I'm following you.
Okay. In simple English, and even with a Southern accent, in these pod classes, we really try not to talk about all of these interesting topics that, one, you can't control anything about it, and it's going to do nothing to improve your long-term financial future, okay? It won't.
So I bet you have an example. You want to share that with us?
You would win that bet. And an interesting discussion, like at the start of 2024, here's one, that is if the Federal Reserve is going to reduce interest rates either 5 times or 6 times in the new year. Well, that was the discussion.
Yeah, but that's not what happened.
No, and it was all just speculation. And if you made an investment decision based on that, well, guess what? 5 months later, 6 months later, discussion is now, are there going to be any rate cuts during 2024? And is there a chance even maybe for a rate increase? And none of that chatter was going to help you approve anything about your long-term financial future. It's interesting, but it was really kind of just irrelevant.
So what I'm hearing is that you take the position of just not commenting on anything that you cannot control.
Yeah, it's a general rule. I would say that's true. It's not that we don't get tempted to talk about something, but we try not to. And we don't speculate about things like the war in Ukraine, the Israel-Hamas conflict, the possible war between China and Taiwan. There's all these things that's like, we also don't worry about the direction of the dollar, the direction of the election, the direction of inflation even. We certainly don't talk about the macro stories. A lot of people will refer to it, and not even the direction of that high pressure front over Kansas, Megan, that's heading this way.
So basically what you're saying is all of that is a waste of time.
Well, how about we refer to it as an interesting and entertaining waste of time, okay? But yes, what isn't a waste of time is making sure that our podcast listeners understand what is under their control, what they can manage, and to understand this dividend growth strategy that we keep harping on, that this may materially improve their long-term financial future. That's what this is all about.
So I think the podcast listeners just heard you repeat your dividend growth strategy one more time.
I think you are correct. And, I gave the guilty plea about harping on all this because, once again, it took me 6 long months for this to sink into my little thick head, or actually my big thick head. And I'm assuming our podcast listeners need some repetition as well.
So you're on a mission, basically.
Oh, no. We're on a mission because you're just as guilty as me about harping on all this stuff. You're a party to this, Megan. You know that.
Can you give us a little preview of what you're going to harp on in the next podcast, please, sir?
Yeah, absolutely. On the investments page of the website, theorganizedinvestor.com, if you haven't heard that before, at the bottom, you can click on a link titled 10 Things You Should Know About Bear Markets.
So are there any particular type of bear markets you're going to discuss?
I don't think it's right to do bear profiling. I think that can be kind of not good in today's society, but it's really about just bears in general, Megan. And by the way, did you know that Smokey the Bear, Smokey the Bear's middle name?
Are you wanting me to say the?
Actually, I do. Smokey the Bear.
Okay, but let the record show that technically Smokey the Bear's real name was actually Smokey Bear, and the wasn't actually ever a part of it. Did you know that?
Well, yeah, but that kind of messes up the joke.
Okay. Well, also, let our record show that Smokey Bear had a wife and her name was Goldie. Did you know that?
I wonder if that has anything to do with Goldilocks and that bear family, the 3 bears.
Oh, I know that story well. Maybe. While they were at the National Zoo, they actually adopted a son in 1971. Did you know that?
So was he like Smokey Bear Jr.?
Actually, he was Little Smokey. So he was the third bear in the family where Goldilocks did that home invasion. Do you remember that part of the story?
I wonder if Little Smokey was a rescue.
So we'll continue our deposition of Jerry Goodman in the next podcast as we make the case about materially improving the long-term financial lives of our clients.
And if you would consider Smokey the Bear to be a friend, we'll explain why bear markets can also be the friend to your portfolio. And by the way, Megan, let me just close by saying all this talk about Smokey or Little Smokies makes me want to go to Buddy's Barbecue and get their hot dog, which is called Little Smokey.
They do have good hot dogs. And I promise this is not a plug for Buddy's Barbecue. It's like free advertising for them.
But I'm going to have to run and get something to eat now.
I know. I'm hungry. Well, let the record show also that the rates of returns we've shared are for informational purposes and that the past performance is no guarantee of future results.
And don't forget that the returns for each of our client accounts can also vary based upon the client's individual circumstances, such as when they started the account, what their investment objectives were, all of those fun things.
Is this your favorite part of the deposition?
How'd you know? I also enjoy saying that these rates return for our advisory clients, they were compiled from all the month-end performance reports for each of those 190 accounts respectively. And it's like way too much information to try to place on the website in any kind of understandable way.
So are you about to say that in addition to covering this summary information, we're happy to cover all of it either in a face-to-face meeting at our office or maybe on a Zoom call, which might be more convenient for you?
Well, I don't need to say it now, but I would just say we have lots of boring information to back up all these statistics, and we're happy to cover it with anybody brave enough to do so.
And remember, only you can prevent forest fires.
I feel a little singled out by that because, actually, it really should be only everyone can prevent forest fires.
Well, maybe Smokey wasn't talking to you personally.
Now, all I know is he was looking right at me on TV and even pointed his paw at me.
Oh my. Okay, so let's wrap this up. Be sure to follow us on social media such as YouTube, LinkedIn, Twitter, and save us to your favorite PodCLASS player to receive reminders of future episodes. We have more to share, which means you have more to learn. So join us next time. Thanks for listening. And this PodCLASS is dismissed, recessed, and adjourned. Until next time.
And only you can prevent those forest fires, Megan. Only you.
You had to have the last word.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or TN Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. The Organized Investor cannot accept trade or account instructions on or through this platform. Please contact us directly at contactus@tnwealthmanagement.com or 865-415-2060 to place a trade or for trade or account-related questions. Brokerage and advisory services are provided by TN Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by TN Wealth Management for educational platform purposes.